Welcome, everyone. Thank you for attending this fourth installment of our Risk Reveal series, US AML Reform, the regulatory impact on digitization, and the new banking landscape. My name is Karen Rines, and I'm the Marketing Manager for the Risk Business at Refinitiv, and I'll be your webinar host today. Before we begin, I'd like to cover a few housekeeping items. First, some technical points to note. There is no dial-in number for the audio. Your device's sound is what will broadcast the audio, so plug in your headphones to listen to this webinar. Click the media player on your screen to enable the sound and ensure that you have Flash enabled on your browser. And if your screen freezes, refresh your browser. Usually that'll unlock it. If you have any technical difficulty during the webcast, please click on the Help widget, which is the question mark icon on the toolbar at the bottom of your screen. This covers troubleshooting for common technical issues. You can expand or minimize your slide and video windows by clicking on the Maximize icon on the top right corner of the window, or by dragging the bottom right corner of the slide area to expand it. At the top right corner of your audience console is the Q&A box. Please submit your questions in this box. Our presenters will answer as many questions as they can during the last 5 to 10 minutes of this broadcast. Finally, the link to the recorded webcast, a copy of the slide deck, and other resources will be emailed to you after the conclusion of this event. Now, I'd like to introduce you to our panel moderator today, Susan White. Susan is Head of Business Development in the Americas at Company. She works with clients and partners to provide solutions for their specific compliance and regulatory challenges. Company is an industry leader in providing real-time audit-proof business verification data for businesses, KYC, KYB, and AML needs. With that, I'm going to go ahead and turn it over to Susan to introduce our panel and get the discussion underway. Susan?
Thank you, Karen. Hello, everyone, and welcome. Thank you for joining us. We're excited that you're here because we're expecting a lively discussion from our panelists. They bring insight and passion to AML, regulation, and digitization. And as Karen mentioned, you feel free to ask questions as the session is running in the Q&A function. And if you have a question for a specific panelist, please specify that. It's my pleasure to welcome our panelists. Kate Banks has spent more than 20 years working in compliance focused on KYC and AML for JP Morgan, Bank of New York, ING, and AIG. And she's been in roles that many of you are in now. In her role as risk proposition specialist at Refinitiv, she uses her experience and expertise to guide financial institutions as they embrace automation. Chris Tosin is head of risk data analytics and automation at M&T Bank. Chris has firsthand experience with evaluating and automating operations relating to regulatory change, both the anticipated and the unanticipated. Rachel Woolley brings a strong background in global regulatory compliance, specifically relating to AML. And Rachel works with clients as they navigate through automation and the regulatory environment in her role as Global Director of Financial Crime at Fernergo. Jeremy Kuster has a background that is anchored in senior roles at the U.S. Department of Treasury, which included FinCEN, where he drove efforts to be more responsive to how technological advancements impact the conduct of BSA and AML compliance. He's leveraging this knowledge now as legal counsel for White & Case in Washington, D.C., to help clients meet their AML goals. Welcome, all of you. And first question, can we go to the next slide? Thank you. Jeremy, a number of AML policy issues have been coming to a head during this latest session of Congress, from glaring gaps in AML coverage to structural inefficiencies in AML compliance. And to address these issues, there have been bills and amendments that have been winding their way through Congress. Are you able to give us a quick overview of what was introduced and where we stand now?
Sure thing, Susan, and thank you for having me today. I think there are two real principal bills, though there are usually many more that are advanced in each session of Congress. But the two that are most relevant are the Corporate Transparency Act in the House and what is called the AML Act in the Senate, which was previously proposed as the Illicit Cash Act. The Corporate Transparency Act was passed in the House previously, and it included something called the Counter Act. And so the two major parts of that bill were a beneficial ownership requirement, requiring individuals who are registering businesses to report that information to FinCEN. And then there was another part of that, the Counter Act, which was a general AML reform bill, which sort of talked about SAR reform, structural reform of FinCEN, privacy issues. In the Senate, the major bill, as I said, was the Illicit Cash Act, which in many ways mirrored the Corporate Transparency Act. It also had a beneficial ownership requirement, and it sort of took a slightly different approach to AML reform, focusing a little bit more on feedback from law enforcement. The Senate has not taken up the Illicit Cash Act for full Senate consideration. I don't believe that it's even passed through committee quite yet. However, with the term coming quickly to an end, I think there was a thought that maybe we could attach these AML reform bills to a must-pass piece of legislation, which is the National Defense Authorization Act. The House attached an amendment to their version that pretty much mirrored the Corporate Transparency Act. And on the Senate side, there was an amendment that was submitted that contained the AML Act, which was said was previously the Illicit Cash Act, but it was never actually proposed, so it was never voted on by the Senate. However, the version in the House was voted on and was included in the House's version of the NDAA. It's hard to tell without insider information whether that will go through in conference, but my bet is probably not. I'm not particularly confident that these bills will move forward. And I think one of the telling signs was the Senate didn't take up their version of the amendment. So there's no real record of how much support there is in the Senate. I think as this is a must-pass piece of legislation, which still hasn't passed, I think there's going to be a bit of pressure on the Congress to come to a pretty vanilla NDAA. And I suggest that it's not going to include the AML reform bills, but I've proven wrong before. Now, I know there's a lot of interest in the beneficial ownership side of the equation, and we can talk about that a little bit. But I do think that there's also some really interesting aspects to the broader AML reform, like SAR reform, that I think should get a lot more attention. And another aspect that's not discussed in the legislation is all the efforts of the regulators over, I would say, the last 2 years, who are growing more receptive to AML reform initiatives. There's an ABSA reform working group between Treasury and the various regulators, and they put out some product that are actually quite interesting. So there's a lot of movement in this space, and it's not just in the legislation. So we shouldn't hang our hat totally on it, but there is some really there's some opportunities there as well.
So the sentiment is moving towards the reform, you would say.
I would say beneficial ownership is still very important. My personal perspective is that it is very important, but as currently constructed, it's not going to be implemented for quite some time. FinCEN is not built to manage information in this way. It's going to take at least 2 years after the passage to promulgate the regulations and start the reporting. And by then, you may or may not have FinCEN ready to ingest the data and then be able to share it back with financial institutions. I don't see financial institutions having to change their CDD procedures for many, many years until after this legislation passes, if it ever actually does. However, opportunities in SAR reform, I think, are more immediate. I think there are opportunities to talk about feedback from law enforcement. I think there's opportunities to talk about automated SARs that can really change how a financial institution conducts AML compliance and investigations that are much more immediate and there's much more opportunity to advance the cause.
Right, and certainly Rachel could actually give us some insight because into what we might expect here from a beneficial ownership perspective, and also maybe from a SAR reform perspective. And Rachel, Europe is no stranger to regulatory reform. What sort of challenges did financial institutions face as they tried to comply? What worked, what didn't? Do you have advice for U.S. financial institutions?
Yeah, I mean, I guess advice and maybe some fair warning as to what's occurred in the EU over the last number of years. So anyone who is familiar with the approach that the EU takes. You may have heard of the EU AML directive. So right now we're a few months past the deadline date for the 5th AML directive, and we're a few months ahead of the deadline date for the 6th directive. So there's been quite a lot of reform or overhaul of the AML environment in the last number of years. Now, the directives introduce different requirements, so it's not all the same thing changing all the time. But certainly one of the key trends that we've seen is continued enhancements to the beneficial ownership regime across the EU. One of the big issues from an EU perspective is that the way that the directives behave is that every member state in the EU is required to transpose the requirements into national law. So what that leads to is essentially divergence in terms of, one, the interpretation, and two, the timing that becomes applicable in national law. So again, if you're operating cross-border in more than one member state, you may be subject to different requirements for the same customer types and so on. The big thing that I think really caught people up under the 5th directive. So once the registers of beneficial ownership were introduced under the 4th directive, there is obviously a requirement on legal entities to register that information with the local company registrars. Under the 5th directive, that information was made publicly available. However, it cannot be used by financial institutions to identify beneficial owners for onboarding purposes. And in fact, it went a step further and put an obligation on financial institutions to collect beneficial ownership information independently, compare that information against the national register, and there's an obligation actually to report any discrepancies. So in summary, discrepancy reporting is now applicable for member states that have transposed the 5th directive. So that's put an incredible operational burden on an already burdensome process of onboarding. And really, certainly when you're looking at new regimes introducing corporate transparency and so on, the question is really around the validity and the accuracy of that data. So, introducing a requirement to register beneficial ownership information, it guarantees that information is only reliable or only accurate at a point in time. It doesn't guarantee that information continues to be accurate and continues to be usable. So there really needs to be a lot of questions asked as to who that responsibility falls to, who verifies that information. We know in the EU already that a lot of corporate registries don't actually verify any of the information provided to them. It's to some degree taken at face value, which also raises concerns then because, even if the information is provided, there's no guarantee that it's accurate or that it's truthful. So there's a lot of questions to be asked around, as I said, the validity and the reliability of that data. So it really brings into question the point of introducing corporate transparency if that's not going to be managed appropriately. And to Jeremy's point around being equipped to deal with that, it's similar, and I'll digress a little bit to the SAR reform piece. It's similar in that sense, and part of the reason I suppose that information is no longer or is no longer considered reliable or accurate is because there aren't sufficient resources to make sure that that's the case at the company registries. And it's the very same story that we've seen in a lot of financial investigation units across Europe. Thousands upon thousands of suspicious activity reports are submitted to the FIUs every year. And if you look at any of the mutual evaluation reports published by the Financial Action Task Force in recent years, a lot of them call out an issue around resources in the financial investigation units to actually adequately assess those reports. So there's a lot of activity, I suppose, in terms of how to automate or increase the efficiency of that reporting process and really make sure that we're adding value in terms of the analysis and investigations that are subsequently undertaken. So lots of further collaboration, I think, that's required across public and private partnership industry and so on. But I definitely think, both the EU and the US can certainly learn from each other on how to create that holistic environment to prevent financial crime.
Yeah, and I wanted to, for you and Jeremy, if you can talk about a little bit about, a little more insight, of like the cost of non-compliance, how quickly you're seeing regulatory change, and maybe touch upon some of the lessons that were learned both here and abroad, and I'll open it up to the two of you.
Well, why don't I lead off? Just the pace of regulatory change, I think, is one that you can't view from just a single lens, particularly if you're an internationally active financial institution. The U.S. has been sort of slow recently, not a lot of new rules being promulgated, some guidance, but not a lot of new rules, not a lot of enforcement on AML, particularly recently.